Well, the first thing I'll do is I do refer to this as the uranium boom boom. And the reason for that is we've just seen a significant uptick in uranium equity prices over the last several months as a result of really good news coming out of the newly elected president and his envoy for climate change. And so there was some questions around the Democrats' policy, although they did say during the election that their policy was that they were technology neutral, and that is left speak for it. We actually do understand that nuclear is very clean, and we might support it, but we don't want to say it out loud. So when people say they're technology neutral, that's exactly what they mean. And so for the first time in 48 years, the Democrats had, as part of their energy policy, technology neutrality, which is great. And then you saw the bill that went through the Senate committee that had bipartisan support to support the nuclear industry in America. Now, why is that important? Well, America is 28% of the entire nuclear market globally. Obviously, China is growing. American growth is fairly static, but Chinese growth is quite high, and they will come out with a new 5-year plan, and I think accelerate that. But right now, and for the next, let's say 5 years, which is an important time frame for Vimy, the US is 28% of the market. Nuclear is 20% of their electricity, and it's 55% of their clean energy, followed by hydro and wind. So it's a really important part of the energy landscape in America, but more importantly, electricity. And we saw in Texas what happens when you have an over-reliance on intermittent power sources. So the thing is, all of that really positive sentiment coming out of America is what really led to the recent boom in uranium equity prices that we saw. Now, the second boom, which hasn't happened yet, is the price. So the price is still around, it's around $28. That's the spot price. But really importantly, the spot price is not a lot of people don't know this about uranium. When you look at copper, nickel, gold, those are true spot prices in a market which has a clearinghouse. In other words, people sell metal into a clearinghouse, people buy it out, and there's a true market there. The spot price in uranium, it's a misnomer because it's actually an arbitrage floor price. And by that, I mean that 90% of uranium is sold between producers and consumers on private contract, most of which are never see the light of day. But there is a small coterie of people who buy extra uranium from various sources. It can be from the enrichers, it can be from miners, it can be from other traders, in the hope of obviously flipping it at a higher price. And that's why I call it an arbitrage market. Now, there's no publicly recorded, geez, sounds like I'm in New York with that ambulance in the background. There's no publicly recorded place where all of the transactions go. So we have two price reporters, UXC and Trade Tech, and what they do, they make educated guesses as to what a consignment of uranium, the minimum consignment being 100,000 pounds, what a consignment of uranium would sell for today. So the best way to think about it is you have a stock on the share market, which has very little volume, doesn't trade every day, but the stock market decides to give it a price anyway. Normally what happens is the last transaction is the headline price. But in the case of the spot market, what happens is both of the reporting entities have a stab at what would the price be today if there was a transaction. And that's kind of it's a bizarre market, and it's always going to be the lowest possible price because, as I say, it's an arbitrage market. Now, what's the real price? Well, that's a great question. So when the utilities buy and sell uranium, that is not made public. We do have intel. We've got a guy in the States, Scott Hyman, who spends a lot of time speaking to utilities, but even then we don't have a clear see-through. The only real see-through you see is the Energy Information Agency, EIA, .gov in America, that collates the data in an annual report that comes out in May. But even that's very granular. So it's very difficult to see individual contracts. And what you do is you get a range. And the range is quite high because some contracts are related to the spot price through the contract mechanisms. But some of the spot prices are very high into the 60s and 70s. And those are probably legacy contracts. So what needs to happen is the US utilities, who have been running historically higher inventories, particularly during the teens when uranium was plentiful, thanks to Kazatomprom. They ran significantly higher than historic inventories, and they're now working through those inventories. And as they do so, they will need to start getting back into the contract market. While this has been happening, you've seen supplier side discipline from Cameco and Kazatomprom. Before COVID, you saw them starting to pull back on some of their production, particularly Kazatomprom, who brought in an ex-energy trader to really westernize their systems, a guy named Riaz Rizvi. He came in 2017. He's since left. And Riaz was brought in to help Kazatomprom modernize their marketing and also get them listed, which he's done. And so what's that seen is that's seen Kazatomprom move from a quantity-based mentality into a price-based mentality. And because Kazatomprom have to sell uranium at market prices, and because the only market that exists is the spot market, they would certainly like to see higher prices. Now they're a low-cost producer, so they can make money at lower prices. But the only way they're going to make money is if the spot price moves up, and so that results in them having more discipline than they had during the teens. Cameco likewise, they closed one mine owing to low prices and the contract market not being where they needed it to be, so they'd rather leave a valuable asset in the ground. And of course, you had COVID. And one of the real Twitter uranium followers, John Quakes, made the point that Canada now has negative 1.5 million pounds per annum uranium production because nobody's producing uranium in Canada. And in fact, Cameco have to go buy uranium to fulfill contracts that they have with Cameco, which is one of their joint venture partners. So what does all that say? It's a very confusing market. But the key thing, and this is the really pivotal point, because of supply side discipline, because of COVID, because of prices, what you saw in 2020 is around 120 million pounds pulled out of the ground and about 180 million pounds burned. So you're now seeing the shortage coming. The utilities, as I say, are sitting on their inventories. Those inventories include uranium that's in the fuel cycle, ready for the next reload. And there's a couple of really interesting quotes from discussions that I've had with utilities. One is, we worry about tomorrow's problems when it gets to tomorrow, wow, which is interesting. Yeah. And the other is, and this isn't a direct quote, this is my, let's say, my version of a lot of different discussions, is we'd rather be the last guy in at 65 than the first guy in at 50. And basically what that means is if the spot price is low, the spot price will react once the uranium marketing, once the uranium contract cycle starts up in earnest. And so no one wants to be the price maker. No one wants to be the first guy going in at above the odds, but they don't mind being the last guy in because they're the hero getting the uranium, and security of supply becomes very important. Now, the difference between, say, $55 a pound and $65 a pound is 0.013 cents a kilowatt hour. And so these guys are a 1 gigawatt reactor uses 440,000 pounds a year. $10 is 4.4 million, and they're producing 8 billion kilowatt hours. So you can see that they while everyone is price sensitive, especially if you're competing against gas and heavily subsidized renewables, at the end of the day, it's not that big an impost on them to pay a little bit extra for the uranium, and security of supply will win out. So the best way to summarize it is we're playing a game of musical chairs, and as time goes on, there's fewer and fewer chairs. And getting a new mine up and running, I can tell you from experience, takes a long time. So there's this systemic shortage coming. The music's going to stop, and everyone's just going to grab a chair and pay what they have to. The last time it was very quick. I mean, there were some circumstances that accelerated it. The flood of Cigar Lake. But I think you'll see a fairly steep curve as it goes up. Now, the curve inside the contract market will be probably less intense than the spot market because there's an overlay of speculation. You still have cheap debt, so you'll get a lot more speculators coming in as the volume increases. But my view, and when you look at cost of production around the world, right now, I think you need 45 to 50 just to sustain current production, and you're going to need 55, 65 to get new production that we need for the growth. So it's as I say, it's really hard to get see-through on what prices people are going to pay. I call it, the way these utilities work is they do both off-market discussions, which we do. We have, like I said, Scott Hyman in the States working on that, but they also do requests for proposals and RFPs. And as those RFPs go out, you'll get the people who have lower cost bidding into those contracts. But eventually, the utilities will have to do what I call climbing the cost curve. So they're just going to have to pay more and more for uranium as those lower cost producers come off. And basically lock away their offtake. So it's going to be, the timing of it's really difficult to predict. People say, when do you think the uranium price is going to go? And I always say, January 2019, because that's when a lot of these things were starting to occur. But the U.S. utilities have just shown a penchant for just using their inventories wisely, I don't want to predict when the market's going to pop. That's a really, really good question. And the difference is, well, there's two differences. One is Kazatomprom have been working their shallower, higher grade fields. And as that company continues to develop their uranium fields, they need to go deeper, lower grade, and it just makes recovery and costs higher. The Kazatomprom that you have today is quite different than the Kazatomprom of the early teens. So in the early teens, these guys were a former Soviet republic running accounting practices that were not Western, and they believed that they could become the OPEC of uranium. In fact, I think the then CEO of Kazatomprom used those exact words. What that showed was a certain amount of naivete with respect to how the uranium market works, because, as I said, there is no spot market. So that thesis would work if we had a spot market like copper, but it doesn't work in a contract market. And the second thing is Kazatomprom have westernized themselves, and they're now listed on the London Stock Exchange. And what that means is they will be putting out guidance. As I said, they are bound by law in Kazakhstan to sell the uranium at market prices. So what they don't want to do is flood the market and drive the price down. They need to strike a balance between volume and price. And so they are much more sophisticated than they were previously. And then as for other companies like Cameco, I think Cameco have made it really clear that, as Tim likes to say, they need a four handle in front of the price, if not higher. And then when you look at the other guys that could come back on quickly, like the Bosses and the Paladins of the world, they're not going to make a huge dent. Their production levels are up there. But then the next tier of miners, which is, the Vimys of the world, there's not very many. When you look at the WNA report, there's only 6 planned mines, and Mulgarock's one of those. So there isn't this sort of huge queue of new uranium mines like you would get with gold. I mean, gold's a very easy product to get up and running. If you've got you discover a highish grade deposit near surface, you can get that into production very quickly. I mean, gold plants are easy to build, and the sciences and the approvals is very simple. But uranium is a completely different story, and I think Cameco has a rule of thumb now that if they made a discovery in Saskatchewan, they'd be looking at 20 years from discovery to production. And I think you'll find that the big deposits in Saskatchewan, like NextGen, they're not going to be in production until the late 20s, and they're going to replace production coming off, maybe Cigar Lake. And so there'll be a natural timing there for those to come in. And, as Kazatomprom said, by 2030, we're going to need 2 more Kazatomproms. So I think there's going to be, with the growth that we're seeing and the renaissance of, let's call it the attitude renaissance towards nuclear, particularly people talking about SMRs now. I think the growth will be sustained. I think the demand will continue to grow, and I think Vimy is really well poised to leverage off that. Yeah, we are. The Mulga Rock project has been through DFS 2018. It was finished last August. I think we put out what we call the DFS refresh. We managed to significantly reduce the capex through some really clever kind of higher purchasing, if you like, of the mining equipment, because we do want to manage the mining fleet ourselves. During our DFS, we did 2 test pits, which is in our latest announcement, which we put out last week, and you can see some photographs of the test pits. So we did those to assess the mining costs. The strip ratio is quite high. It's around 15 to 20 to 1. But the overburden, these are flat-lying deposits. They're effectively dirty lignites. And the uranium is all attached to the carbonaceous material, but the overburden is free digging. These are old, 50 million year old river channels, and so the mining of it's quite easy. So we've done a significant amount of work. When you look at both the DFS and the refresh, you can just see the high quality of work. And interestingly, when we did the test pits, we took 100-ton a sample of ore out of the test pits, and we took that down to Perth to put through a full-scale pilot plant. And by that, I mean anything that had a hydraulic head, like a thickening tank, a leach tank. They weren't built at full size, but they were built at full height, so that we even assessed the hydraulic head. And we were so thorough, we transported 2 tons of process water from site down to Perth to use in the pilot plant, so that we were using exactly the same water with all the elements in it that we will use in the plant. And so that was a really important part of our process. We have the major environmental approvals, both state and federal. We have all of the mining tenure that we need for the project. There is no native title claim over the area, but we do have a very good relationship with the Wongatha, the people who are the custodians of the land. So all of those really major approvals are done. We're working through what we call the secondary approvals. So that's the mining proposal, the works approval, the project management plan, the mine closure plan. And those are all in the system. It's a bureaucratic process that everyone has to go through. It takes time because it's the government. It's the same thing all over the world.
Right.
And we're just working through that process. That's a normal process, and they're progressing pretty normally. Yeah, so the way that we'll do it, the way it'll work is it'll be a contract-led financing. So we need to get contracts. That's why we have a guy in America. And I'll just say, the feedback we get from the utilities is really positive, that we have bothered to hire someone in America to work in America to get contracts. And
Yep.
as far as I know, there are no other juniors with someone in America working for them like that. So that's really important. So what we need to be at is, the utilities look at the big 5, Cameco, Orano, Uranium One, Kazatomprom, and BHP to base load their uranium supply, but they really want diversity of supply for risk mitigation. They want diversity of geography and jurisdiction, and so they see Australia as a key jurisdiction for them. We've done a lot of work on, is there actually a market for us in the States? The answer is yes. It'll then come down to price, and they consider us, the top of, or at the top of the next tier. And so that's been done through several years of relationship building with guys in the States, doing bike rides and going to the conferences and, all of that. So we're really confident that when they start contracting and they get into that sort of tier 2 tranche of contracts, we're very confident that we'll be pretty much at the front of the queue. And frankly, there aren't that many guys who are as ready as we are. There's a few of our peers who have mines that have closed down and are in care and maintenance, and obviously they'll be able to get into production faster. But there's very few mines that are sitting at 3.5 million pounds annual production that can be built and ready to go 2 years from FID. So, when you talk to these utilities, they look at long-term contracts. They'll sign contracts now for delivery in 3 years. So that really suits us, because if we get the contract sorted, that'll trigger the debt. Once that's done, that'll trigger the equity, and by that point, we'd be significantly re-rated. So our component of equity that we'd need to rise wouldn't be dilutive to our shareholders. Yeah, well, certainly we are very leveraged. I mean, when you look at again in our last presentation, we did put some. We run a real time comparable to our peers, and when you look at EV to NAV, we're sitting at 0.12 times. So that's quite low. And the average of our peer group, and the peer group is Vimy, Forcis, Berkeley, GovEX, Vision, Bannerman, Deep Yellow, and Boss Energy. And when you look at the average NAV, it's 0.35. So that's an immediate 3 times leverage. And then 0.12 to NAV, well, that gives you, what's that? 0.12 is about 8 times. So, we're really leveraging. Even on an EV to resource base, we're still very low. We're well below the average. And so, in both instances, we just have incredible leverage opportunity compared to our peers. Yeah, just we recently put out a base metal announcement. We have had base metals in and out of the project for a number of years. The deposits, polymetallic, copper, zinc, nickel, and cobalt occur in economic quantities. They are recoverable. They do come out after the uranium, so we would effectively be treating the tailing stream from the uranium plant, and then we can precipitate base metal oxides. Now, base metal sulfides. Now, when we did the DFS, they were marginal, and we just felt that the risk and the extra cost wasn't worth doing. But when you see the copper, cobalt, nickel prices going up, significantly, we have revisited it. So we put an announcement earlier this year, I think Feb 4th, I think it came out, just explaining that. And we've got a bit of work to do. So over the next few months, we'll be doing an update on the base metal resource. We'll be looking at some metallurgy. We've got the Alligator River project. That's sort of a little smoky that you have in the bottom drawer. That your Alligator River province, the uranium province, hosts 2 of the world's biggest mines, Ranger and Jabiluka. Jabiluka is 350 million pounds. The geology up there is identical to the Athabasca Basin, except up there it's just hot and dry as opposed to cold and wet in Saskatchewan, where I worked for 2 years. So yeah, I actually grew up in Canada, and down the road from the Pickering nuclear power plant. Went to Queens, and then I spent my last 2 winters in Canada in the mid 80s doing geophysics in northern Saskatchewan in the wintertime. And in fact, we were on the crew that first went over McArthur River. So I've got a long history. In fact, back in 1981, my first summer job was underground in Uranium City. So I've kind of got uranium in my blood. And, I'm hoping I started my career as a 18-year-old underground in Uranium City, and maybe I'll finish my career when we cut the ribbon up at the mine in a couple of years. So the website is Vimy Resources, all one word, .com.au. If you've got any questions, it's info@vimyresources.com.au. If you search on YouTube, you'll see some of our videos, but on the website, you'll see links to some of the videos we've done. Get on the mailing list, because Patricia, who's my long-suffering and excellent executive assistant, often puts out MailChimps with news articles, obviously all of our ASX announcements, but just other interesting things. And down the back, there's a lot of useful links. So it's a good site. If you are interested in the technical aspects of the project, really recommend downloading the 2018 DFS and also the update that we did. That DFS document. I used to be a consulting geologist, and we used to do a lot of DFS, definitive feasibility studies, and pre-feas studies. So I've done a lot of studies, and I got to say, and you might think I'm biased, but I've got to say that the study we did for this project is one of the best I've ever been associated with. Very thorough. The actual DFS and DFS refresh, there's enough data in there that you could do some really robust modeling on the economics. So if you're a real, Excel geek, you could have a lot of fun with the data in there. So look, pin your ears back, have a look. Always happy to answer emails, and always happy to come back and have another chat.
Make sure to visit silverchartistnation.com for a free weekly chart pack covering early stage assets ready to lift off.
This discussion is for informational purposes only. Nothing in this discussion should be taken as investment advice. Guests are not compensated for their appearance. Do not base any investment decisions on the information presented.